Hello everyone, I'm Conrad. Welcome back to the channel. It's been a while. So in today's episode, I'll be talking about the markets hitting all-time highs, valuation versus pricing, as well as some insights and some thoughts that I have on certain companies that I own, as well as some companies that I'm looking to own. So first of all, let's talk about the markets hitting all-time highs. So the markets after the dip, after the Iran war dip, is actually up at all-time highs again. So it reversed the entire 10% drawdown. And currently, we're seeing pockets of euphoria in the market again. So for example, yesterday, I believe there was a shoe company, it's called Bird. What they did was they sold off their shoe company and then they're rebranding themselves as an AI company. And then the stock shot up by, I believe, 800% in a single day. So there's a lot of speculation in the space. And that brings me to my argument today, which is the difference between valuation as well as pricing. Pricing refers to what you expect other investors to price the stock at, maybe in a 6-month period or maybe a year from now. So pricing is more associated with speculation. You're basically looking at a stock, thinking about whether or not other investors are going to basically push the stock up. It's a bit more like momentum investing as well. Whereas valuation is looking at the intrinsic value of the company, looking at the free cash flow, looking at the terminal growth rate, basically looking at the entire intrinsic value of the company discounted to present value. So in the markets today, we're seeing a lot of speculative investments coming up. So my belief is that there are many different ways to make money in the stock market. It is not an exclusive method, but my problem is simply just the replicability of looking at just pricing alone. So if you look at just pricing alone, you're basically betting on whether or not investors will push the stock up in a 6-month period. But if you look at the intrinsic value of the company, then it is more predictable in the long run. It is more replicable. And when you see a detachment between value and price, that is when you buy into a company. Okay, so enough about valuation versus pricing. I think if you watch the channel long enough, you probably know the difference between the two. And in channel, what we do is we focus on value rather than just the pricing alone. And that brings me on to my next topic, which is some investments and some stocks that I've been adding into over the past month or so, as well as some other companies that I'm currently looking at. So I'm sure if you've watched the last few videos, you probably have an idea of what companies I've been adding into. So the 3 companies that I've added into during this entire Iran-Israeli war is Visa, Microsoft, as well as Safran, and a bit of Airbus. So I explain each of the theses over here as well as why I'm actively looking at Safran right now. We'll start with Visa. I think Visa is just a stable compounding machine that will compound intrinsic value for a long period of time. Why is it able to do so? Because number one, it is not at risk of any form of crypto disruption because they are already doing it. Second of all is that consumer behavior will unlikely change. Third of all is that the markets are probably not pricing in anything related to VAS yet. So VAS has been growing very strongly over the past few years. And if you look at all the consensus estimates, most of it is derived based on consumer behavior, consumption, as well as GDP. So VAS may not be priced in yet. And for Visa, if you look at the trailing multiples, the median multiple over the past few years, I believe it is at one of its historical lows. And that's why I added to my position. That's for Visa. Second of all, it's for Microsoft. So Microsoft, I added to the position during the Iran-Israeli war as well, because for Microsoft, I believe number one, the software sell-off is overblown. Why is the software sell-off overblown? Because first of all, AI is currently still probabilistic. Of course, AI can become a lot smarter over the next few years. But if AI is still probabilistic, what it means is that the AI will likely benefit companies that provide repetitive tasks. So for example, Microsoft's suite of products is mostly for repetitive tasks, like making of slides, like doing your Excel and so on. And so Microsoft will likely be able to benefit from this. And the second thing to note is this, over the past few days, if you look at what Anthropic actually did, what they did was they swapped from a, I believe, subscription-based business model to a usage-based business model. So what they're doing right now is they're charging a base fee. And then above that base fee, it is all consumption. So I believe this is their way of signaling to the entire markets that the demand is very, very strong. The demand for their services are very, very strong. And by providing this consumption-based system, they're basically protecting their margins if the demand is very high. Similarly, if you're to extrapolate this to all your different other software companies, like for example, Microsoft. Satya has mentioned previously that they're actively trying to push Microsoft towards more of solution-based rather than seat-based, which is similar to what Anthropic is doing. So if you're to extrapolate and think about what Anthropic is doing, think about what Microsoft will likely adopt in the future and push forward as well. If Anthropic is doing it, then likely there is already success with it. So the argument that the seed base will be diluted is a weak one because the consumption will likely catch up to it. Okay, next two companies, Safran as well as Airbus. Airbus, I've explained it previously already. For Safran, it's a more unique one. So if you're to look at the stock itself as well as the company's forecast, everything is quite bright. But my opinion is that the management is still being a bit conservative. Why? Because for Safran, the unit economics for the company is driven primarily by shop visits. Meaning to say, when companies go in and get maintenance, they get spare parts from Safran, that is when they make the bulk of their money. Because for Safran, they sell their engines typically at a loss and then they try and recoup it back over the next 3 to 4 shop visits during the lifetime span of the entire aircraft. So your shop visits are typically at 8 years, 14 years as well as 22 years. And then in some rare cases, you will have another shop visit, which is at around the 30-year mark. So for Safran, I think management is currently being conservative because management is saying that in 2028, it will be sort of like the peak. And then after that, it will start going down in terms of the shop visits. But if you're to look back at the past few years, so for example, for the year in 2028, what you can do is look back at the deliveries in 2020 and then minus 14 years, minus 22 years as well. And what you will see from that trend is that it doesn't really pick out in 2028 because there was the COVID delay as well. So there's a lot that's being pushed back and I think management is being conservative. My pick is currently at around 2032. So it's around 4 years after management's forecasted pick. And Safran has always had a history of being conservative apart from COVID. COVID was a black swan event. So for example, this year, they only guided up 8 months after GE guided up. So GE initially already guided up, they already raised their guidance, but Safran didn't do so until this recent earnings call. So the management has been quite conservative. In terms of valuation for the company, I think the way for you to look at it is to use the EV to EBIT. And EV to EBIT right now normalized, I believe it's at around 24 times. So it's not exactly cheap. If you're to apply a 25% tax rate on that, the company now is currently trading at around, I believe, 31 times normalized price to earnings. So it is not cheap by any means currently. Still waiting. I have a starter position for Safran. I think the company is a compounding machine and you have a catalyst in this upswing coming up in terms of shop visits. And you had a war as well. So the war will likely push companies to go for shop visits, to make sure that they repair their parts, to make sure that they maximize their fuel efficiency in case the oil prices remain high for a sustained period of time. Okay, next one, let's talk about FICO. So FICO, I believe, is down another 20% since the last time that I spoke about it. I think the stock is not yet cheap. Why? Because there are still some portions that are not priced in yet. In fact, a lot of the effects of Vantage Score hasn't really been priced into the company yet. Why do I think so? Because if you're to look at Vantage Score versus FICO Score, currently now there's something called an LLPA grid. I've spoken about this before. LLPA grid is basically what Fannie Mae as well as Freddie Mac use to tie a score towards the amount of risk that they take. And currently only FICO has it, meaning to say only FICO scores, your FICO Classic scores, have the LLPA grid. And what that also means is that Vantage scores are currently not actively being used. Although it was announced last year that it is usable, it is friendly towards Fannie Mae as well as Freddie Mac. So what this likely means is that FICO is still dominant now temporarily because your LLPA grids are still in place, because LLPA grids are only for FICO Classic scores. When you have an LLPA grid coming up, I think Q3 of this year for Vantage Score, you will likely see some form of market share loss for FICO. And that being said, I think the effects of this is likely not in yet. So I'm still a bit cautious about the company. I own a 1.5% position in it. It's a relatively small position. For FICO, I think the valuation now is okay. So if you're to look at the price increase that they had last year, it will likely impact their EPS this year. So this year I have my models at around 40% increase in terms of the EPS just based off of pricing. In the years ahead, that's the problem for the company. We don't know how the prices will be for their FICO score. And when you have a company like Vantage Score with the 3 different credit bureaus coming out with this system, trying to actively disrupt the industry, that is the concern for FICO. Because I don't believe that they can continually increase prices like what they did over the past few years. It will likely, at best, be inflation-adjusted pricing because there's a clear alternative there already at $1. Yeah. And as for your direct licensing, I'm aware that FICO is signing a lot of deals with companies that are in the pipeline. So the whole mortgage system works like this. You have your pipelines that connect the credit bureaus to your lenders, the pipelines are actually quite important. Pipelines are basically your mortgage licensing platforms or your mortgage operating platforms. So FICO announced that they signed a few deals, your direct licensing deals, with a lot of the pipelines, and I think the number quoted was around 60% of the pipelines have already been signed. But the problem with that is a lot of people have misconceptions. They believe that this means that FICO is exclusive on those pipelines, but this is actually not the case. Vantage scores are actually also provided on those spaces because they link the credit bureaus to the lenders, and yeah, the credit bureaus are the ones providing the Vantage score. So Vantage score are actually also provided. So the direct licensing deal, the contracts doesn't necessarily mean that FICO is a monopoly. FICO is an exclusive company. It just means that FICO scores are currently provided on those mortgage operating systems. Last part, let's talk about some companies that I'm currently looking at. I'll talk about one software company that I'm currently looking at, which is Topicus. So if you look at the entire software space, I believe a lot of the sell-off is overdone. The markets are pricing in the fact that all these different software companies will not be around maybe in 5 years' time. Adobe, for example, is at 12 times earnings, I believe. So a company that I've been looking at is Topicus. Topicus is a subsidiary of Constellation Software. So Constellation Software, as we all know, is the company by Mark Leonard. Topicus is a company that is below Constellation Software. And for Topicus, if you look at the list of companies that they own a lot of different companies in education, in healthcare, in construction. For Topicus, is a lot smaller than Constellation Software, so you don't run the risk of the company not being able to deploy capital. So I think there are two main arguments for Constellation Software as well as the subsidiaries. I think the subsidiaries are a bit more interesting because they can deploy capital at a higher rate of return. So first of all is the bull case. Bull case is they'll be able to defend the market share because vertical market software is very niche. Your AI companies will not likely come in and take over this very small space. Second of all is that in the private markets, there will likely be multiple compression because of all these different AI fears. Although Constellation Software management team has said that it is not the case yet. We'll have to see. And valuations have come down significantly over time already. So for example, if you look at Constellation Software, I believe it's trading at 20 times price to a free cash flow available to shareholders. So that's an internal metric that they use. Topicus is at around 22 times. Topicus has been growing at around 20% over the past few years. Constellation Software has been growing at around 15% over the past few years. So free cash flow has been relatively strong over the past few years, and valuation has come down to a more reasonable range right now. So that's the bull case. The bear case is that AI will displace them. AI will cause maybe a portion of the entire business to lose some form of pricing power, and for the intrinsic value of the portfolio of companies that they own to fall over time. So yeah, it's interesting. I think Topicus, Constellation Software, as well as DoMine, the other subsidiary, they're quite interesting because they're vertical market softwares that are in very niche spaces. So I think it is impossible for you to completely assess the risk of Topicus, DoMine, as well as Constellation Software. I think the best way for you to approach it for Topicus, for example, is to look at the portfolio of companies and find a percentage of companies that are highly at risk. And my number is at around 25%. So 25% of the entire, I think, 140 companies, I have a whole list, at risk of AI disruption. That is 25% of their entire portfolio. So 75% is still currently not at risk. And for Topicus, they've been pushing for acquisition outside of vertical market software as well. So last year they did an acquisition that was not AI linked. So that's interesting as well. And so these are my thoughts on those companies. I'm still tracking them. I think the price is decent today. Valuation is, we'll have to dig into it. I hope you guys have found this video useful. I will do an entire video for Topicus if I find it really interesting. And I'll see you guys soon.